So now we are going to look at our cash flow statement. Right, so remember we already did the ordinary share capital note in the previous video. So if you want to know where we got these figures from, please go back to the video on the ordinary share capital note in brackets easy, right? So then cash flow statement. So before you even go to the information, you always need to familiarize yourselves with the template. So they've given us the cash generated from operations. So in other words, they have done the reconciliation note. We still need to now include all the other items. So interest paid is there, and they've said we haven't paid any interest. Then we also need to show the income tax paid. And then we also need to show the dividends paid. Doesn't matter what your order is, just ensure that you have all of it. So income tax paid, dividends paid, keeping in mind that for dividends paid, it's last year's shareholders for dividends plus the current year's interim dividend declared and paid. Then cash flow from investing activities. Over here, we are looking at the non-current assets section of our SFP. We want to know, did we acquire, so did we buy new fixed assets? Did we dispose of any assets? And was there perhaps a change in my fixed deposit from last year until to this year? Then if we're looking at the cash flow from financing activities, we want to look at how did we acquire the funds needed in order for us to operate our business. So did we issue new shares or did we obtain a new loan? Could also be that there was a buyback of shares or maybe there was a repayment towards this loan. So that's the information that we are looking for. I'm not including anything here yet because I can see I only have 2 for each one of them, but I have more than 2 things that can happen within these sections. So for now, I'm just leaving them blank. Like I've said, we've already done our note. So I'm going to use the amounts as per the note, and I'm going to transfer that to my cash flow statement. Please do not redo any calculations because we do method marking here. We want to see that you know whatever you calculated here is in fact the amounts that you need to use in your cash flow statement. Right, so an interim dividend of 52 cents per share was declared and paid. So on the 30th of June, you only had 1 million shares in issue because they didn't give you any movements from the 1st of March until 30th of June. So dividends paid in respect of your interim dividend was on 1 million shares that you then paid 52 cents per share. So just add my bracket here. There we go. So we will do the calculations right at the end. Then 50,000 shares were repurchased from a shareholder. Important, we said that we remove the average share price from the ordinary share capital account, and then whatever we paid above the average share price is taken from retained earnings. But the full amount paid must now go to your cash flow statement because in your cash flow statement, you are looking at payments and receipts. So we said this is part of our financing activities where we are going to say that we repurchased shares. We repurchased the shares at the average plus 20 cents because it says it was above average share price. And that was for 50,000 shares. So that's our buyback. Keeping in mind that we had to pay this, so the amount will be in brackets once we have our amount because it's an outflow of cash. Moving on, 400,000 additional shares were issued. We know that because we did our ordinary share capital note. So additional shares issued, this is the amount that we received. So we go to our financing and we say proceeds from shares issued. And we enter our amount there. Then it says the final dividend was declared. We are not going to be concerned about that now because it says only declared, not paid. We are doing cash flows. There's no outflow or inflow of cash when a dividend is declared. Only an outflow of cash when we have made payment. Right. So next up, we have our ordinary shareholders' equity. That consists of our ordinary share capital and our retained income. We have already used our ordinary share capital within our cash flow statement, so we're not going to use that again. With regards to the retained income, also not relevant to the cash flow statement because that is just us looking at the income that we kept within our company that we retained for future growth or future usage. So it's not your cash inflows and cash outflows. Next up is our fixed assets at carrying value. You know, I know, there's no such thing as a fixed assets carrying value general ledger account. However, we are going to create one for calculation purposes only. So if you look at your fixed assets, yes, it's again this beautiful writing with this writing pad, but it's easier to explain it this way. So for all of our assets, we have cost accounts that increase on the debit side and they decrease on the credit side. So it usually starts with the balance brought down because we had assets in the previous financial year. And then we had additions, whether it be cost or credit, we had additions. And then whenever we had disposals, we remove those disposals at cost from our cost account. And then we had a closing balance. Then together with that, we also have the accumulated depreciation account. The accumulated depreciation account increases on the credit side and decreases on the debit side. So we might have some accumulated depreciation from the previous financial year if we owned assets in the previous financial year. Then we are going to add to it the current year's depreciation expense amounts, and then we are going to remove the disposals depreciation, accumulated depreciation. And that will give us a closing balance at year end. So now we are just going to merge these two. And we are going to say that we now have a carrying value ledger account, starting with an opening balance. So it's my cost minus my accumulated depreciation on day one. And they are saying that that was 1.28 million. Okay, 1, 2, 3. There we go. So that's my opening balance. Then I'm going to now look for additions that will increase my carrying value because it increases my cost. I'm going to look for my disposals, keeping in mind that we are doing the carrying value account, so disposals at carrying value to be removed there. And then I'm also looking for my current year's depreciation. My current year's depreciation. Remember, your disposal consists of your cost minus your accumulated depreciation. Excuse me. And that's why we can remove the carrying value, because we could have also said, I'm going to remove the costs on the credit side, and I'm going to add back the accumulated depreciation on the debit side, because then it gives me the same effect, because then I will still have my carrying value within my account. Okay. And then when I'm done with that, it will give me my closing balance. So see, that's how we have now merged it. We have our additions, we have our disposals. We've just now merged the disposals. We've said that we're going to take the cost minus the accumulated depreciation to get the disposals. And then depreciation will increase my accumulated depreciation, thereby decreasing my carrying value. And they then said that the closing balance is 1.74. So we need to now see, did we have additions? Did we have disposals? And what was the depreciation expense for the current financial year? So moving down here. Equipment with a carrying value of 24,000 Rand was sold. So we already know now that we had disposals. So proceeds from asset disposals. And this says that it's equipment with a carrying value of 24,000 Rand that was sold on the first day of your current financial year at a loss of 2,000 Rand. In other words, you received 2,000 Rand less than the carrying value. So 24,000 minus 2,000, you received 22,000 Rand. So there was an inflow of 22,000 Rand. And the carrying value that you removed from your financial records, the disposal, was 24,000 Rand. Okay, so you've already recorded that. Unless they tell you haven't yet recorded the transaction, then you have to. Right. Then it says that a new vehicle was purchased for 400,000 Rand using vehicle finance. So in other words, no outflow of cash there. You used a loan. So they've already included here 400,000. 1, 2, 3. There we go. Then depreciation on vehicles have already been correctly recorded as follows. So 271,200. 271,200. There we go. And then it says that more assets were purchased and paid for during your current financial year. So that means that you now need to go and calculate what was your acquisition of fixed assets. And you're going to do that by taking, oh my gosh, let me just quickly do this. I don't know why it keeps on doing that. I'm over here. Just want to open my calculator. So you started with a carrying value, and then you recorded 400,000 Rands fixed assets that you purchased. Then there was a disposal at carrying value, and you recorded depreciation that resulted in your carrying value decreasing. So according to you, your fixed assets should be this. However, they are saying it's more. And the reason is because you purchased more assets. So 355,200 is in your acquisitions. There we go. So 335,200. They told us that we paid for this. Therefore, it is in brackets. 355, not 335. 355,200 in brackets for your outflow for your acquisition of fixed assets. Okay. Right, moving on. It also says that, oh, sorry, we were here. There we go. It also says that we had SARS income tax at the beginning of the year. We owed SARS credit balance. So we first have to, in the current financial year, we still have to pay SARS whatever we owed them from last year. So tax pay, 24,400. Then it also says that we ended on a debit balance of 10,200. So we've made an overpayment. So apart from the taxes that we had to pay for this year, we paid on top of that 10,200 Rand. Then shareholders for dividends last year, so in other words, the final of last year to be paid this year was 364,500. And then the total dividends declared during the year, but that's fine. We had to use a calculation to get to our interim dividend for the year, so we will stick to that. So we now still need to know what our income tax expense was for the year. So we'll go on to the information that follows. So the net profit before tax amounted to this. Income tax is calculated at this rate. So we now need to use our profit before tax to calculate our tax. So this is 100% of my profits. I want to know what 28% thereof is because I now need to pay that to SARS. Times 28. There we go. We have our income tax. So this is my income tax expense. So remember we said that at the beginning of the year, we owed SARS, so we first had to pay that. Then we have to pay our current year's taxes. And then we also made a 10,200 Rand additional payment during the current financial year. So in total, we paid the opening balance, plus the current year's income tax, plus we made an overpayment of 10,200. So there we go. That's our total outflow of cash because we made payment. With our dividends, it was a 1 million dividend, 1 million shares at 52 cents dividends per share, plus last year's final dividend declared that we paid during our current financial year. So once again, this is an outflow of cash, therefore it has to be in brackets. So now I have all of the amounts in my operating activities. So I had 740,000 from operations minus my 360 for tax paid minus the 884 for my dividend paid. So I have a negative cash flow. So negative cash flow, therefore in brackets of 505. Right, then we are done with our investing activities. We only need to still calculate the repurchase price. So 13 Rand 60 cents is the average, plus the amount above that times the number of shares, so 690,000 Rand that we then paid to buy back these shares. And that's your cash flow statement.